in the startup world, we've seen a lot of lending startups come in and get a good capital infusion also. But there is no clear story emerging, at least, so far.
India's had a sea change in terms of transformation through the internet, right?
Yeah.
The kind of penetration levels, whether it's Geo as well as all of the sort of other telcos that have provided 4G and now 5G networks to the country, has been game changing. Aadhaar has been game changing.
Yeah.
There was always this kind of bullishness that we could build deep lending businesses, right, and digitized, where we could reach consumers who don't have access to capital or the right sort of cost of capital and be able to service them. But lending is a very different business, because in lending, the real sort of capability that you need to have is risk management, right? So having reach versus being able to effectively lend and manage risk are two different things. Second, Indian banks are very efficient, and over time they become very efficient at both. You look at Indian private sector and even Indian PSU banks, right? Look at SBI. Phenomenal reach, huge amount of investments in tech, and they're putting it together and creating a unbelievable franchise. Same for ICICI Bank.
Yeah.
Same for HDFC Bank, right?
Yeah.
So these guys have the best risk management capability, fine-tuned over multiple crises over time.
Yeah.
Right? So their engines are sort of more learned, right? And they're using that with the reach that they have, whether it's branches or digital reach.
Yeah.
And so what's happening is many of the fintech lenders that you see, they're, in my view, that actually extended arms for many of the larger banks and NBFCs to get customers into their fold, right? And they would be very efficient at the reach game. How efficient many of these will be at lending, time will prove. And therefore, in my view, RBI is taking the right corrective action today. Before some of these go and blow up in the future, they're kind of taking the right corrective action. So the regulator also will learn over time. This is a new space.
Yeah.
They will evolve. Lenders will make a few mistakes, fintech will make a few mistakes, the regulator can make a few mistakes. But I think it's a learning opportunity for the entire sector. Whether the long-term opportunity exists or not, it definitely exists. Who will be successful, we'll know over time. So for us in our NBFC space, we started growing as a wholesale lender. So how did we start our lending business? We basically understood the corporate sector very well. We understood the capital market space really well. And we understood real estate really well. These are three spaces in investment banking through our various businesses we could understand well. So we started lending in these spaces.
Okay.
So it was very simple. I know a promoter needs money. He needs to lever to put in some new capital for his new project. Let's find a way to help him with advice on the investment banking side to raise his debt capital resources, his bank capital resources, and an IPO, and also fund him for his requirements, for his contribution. Very, very simple, right? And that's how we started the corporate lending piece, and very closely the promoter lending piece jointly with it. And in real estate, so personally, me being a banker and having covered financial institutions early on in my career, I was very, keenly following HDFC, and I really liked their model. And I figured that there is a big scope in lending into real estate, and banks don't necessarily do it very well, or they're very risk averse. So we built a real estate lending piece. And from that, we extended into home loans. So now we are a significant affordable home loans player. And the third piece obviously was a capital market lending piece, which comes to us naturally, where we provide margin trade financing, we provide ESOP lending and IPO funding and a host of other products to our retail investors and our HNI investors.
Last 2 years have been about IPOs and
Yes.
startup, of course, IPOs, but startup IPOs. And we saw some big ones like Nykaa, and I think JM Financials was involved in that.
Yeah.
What do you have to say? Because again, they are right now, as we said, there is no clear verdict, but there is this thing that maybe we had a lot of hype.
No, but that is true. So, I go back to my own career. So in 99, I remember I was an analyst working in the equity capital markets desk at Morgan Stanley in New York. And in 98, I'd finished my training program and I got into the job, and we just saw this whole boom of internet IPOs in the US.
Oh yeah.
All of 99. And I remember in I think around the end of Feb or first week of March of 2000, the market crashed. And the tech market crashed. Particularly, most of the IPOs that were sort of raised in the previous 18 months, they crashed to at least half of their IPO price, if not lower, right?
Yeah.
And they were all trading up to almost 3 or 4 times the IPO price. So I've seen this happen before, and I remember in the first week of March, I had no work. The month of March, I had no work. Literally, I would go to office, I'd be sitting around, and there was no deal, there was no transaction. Markets are very jittery, investors are very jittery. You see losses every day because stocks have traded off. So I think it's a cycle, right?
You know, you very early on saw
I saw the whole crash.
The boom and the crash. Yeah.
And I saw it come back.
Yeah.
Right? So post 2003, it all came back, right?
Yeah.
So I think one has to figure out, importantly, that are the business models for real? And if the business models are for real, right, they will produce cash flow, right? Then it's all about valuation. And you will see euphoric times where you will see valuations go crazy and investors will get hurt. And that's exactly what you've seen. And it's also kind of exacerbated because you had a huge amount of liquidity in the world.
Yeah.
Interest rates were taken down because of COVID reasons, liquidity was pumped, and you saw crazy valuations in all sorts of companies, not only tech, and you've seen most of it coming crashing down. So I think it's timing. So, you know, people ask me, how do I model my investment banking business, right? Because it's highly cyclical. We've barely had any IPOs last 6 months. And I keep telling that I model my business peak to peak. I don't model my business Q on Q. It's not possible.
Yeah.
But if I look at the peak of the bull market to the next peak, have I been able to grow earnings 15 or 20%? If I have, I've been successful, right? So you have to look at the same, when you have a new business which is not producing cash, disrupting, very smart founders, you know, they will see their ups and downs. But I feel genuinely that I think 70-80% of these business models are true. Half of them are really, for lack of a better word, copied, right? But they'll be successful because you're seeing those business models work really well in the West.
Yeah.
So they'll do well. It's just a matter of time.